The United States owes $36 trillion. China owes 15 trillion. Japan owes 10 trillion. Germany owes 3 trillion. The United Kingdom owes 3 trillion. France owes 3.5 trillion. Every major country on the planet is buried in debt. Global debt, in total, sits around $317 trillion. Let that sink in. 317 trillion. That number equals roughly 330% of global gross domestic product. Meaning this, everything the world produces in an entire year does not even come close to covering what is owed. In fact, we would need about 3 full years of global production with zero spending, zero eating, zero living, just to pay it all back, which is obviously impossible. But here is the question nobody ever asks. If everyone is in debt, who is the creditor? Who exactly is holding $317 trillion in assets? Because debt is a zero-sum game. For every borrower, there is a lender. If the United States owes $36 trillion, that means someone owns $36 trillion worth of claims on the United States. If global debt is $317 trillion, then someone, somewhere, owns $317 trillion in global assets. So who is it? That answer exposes the biggest wealth concentration machine ever created in human history. Not through war, not through stealing, but through a system where the many are forced to borrow, the few are positioned to lend, interest compounds forever, and debt can never mathematically be paid off. It just keeps growing. And as it grows, wealth flows upward. Here is what we are going to break down. Who actually holds the $317 trillion in global debt? How the system creates debt without creating the money needed to repay it. Why this is not an accident, but an intentional design. Who benefits from permanent debt? And why the system will eventually collapse, but only after maximum extraction. This is not really about economics. It is about understanding that the global debt system is the mechanism that quietly concentrates wealth into fewer and fewer hands, while making that outcome look normal and unavoidable. Before we expose who holds the debt, you need to understand what debt actually is in the modern system. Most people think debt works like personal borrowing. You borrow $10,000 from a bank. The bank already has that $10,000. You pay it back, plus interest, and everyone moves on. That is not how modern debt works. When a government borrows money by issuing bonds, the money does not exist beforehand. The act of borrowing creates the money itself. Central banks and commercial banks buy government bonds by creating money out of nothing. Just digital entries on a balance sheet. Here's how it plays out. The United States government needs $1 trillion. So it issues treasury bonds. The central bank announces it will buy 500 billion of those bonds. Commercial banks buy the remaining 500 billion. Where does the central bank get $500 billion? It does not have it. It creates it. Numbers typed into a computer. On its balance sheet, assets go up by 500 billion. Liabilities go up by 500 billion. Money that did not exist before now exists because a bond was purchased. Commercial banks do something similar through fractional reserve banking. So when the government borrows $1 trillion, that $1 trillion is created through the borrowing process itself. But here's the part that changes everything. Only the principal is created. The interest is not. If the government borrows $1 trillion at 5% interest, it must repay $1 trillion plus $50 billion in interest every year. But only $1 trillion was ever created. So where does the $50 billion come from? From future borrowing, or from taxing money that already exists in the system. That is the trap. Total debt always grows faster than the money supply because interest is owed on money that was never created. The system requires endless expansion of debt just to keep functioning. This is not a flaw. This is the design. Now that you understand that, we can talk about who actually holds the debt. There are 4 main categories of creditors: central banks, institutional investors, foreign governments, and wealthy individuals. Let's start with the first one, central banks. Central banks are the first major holders of government debt. The Federal Reserve holds around $5 trillion in United States government bonds. The Bank of Japan holds roughly $5 trillion in Japanese government debt. The European Central Bank holds close to $5 trillion in European government bonds. The Central Bank of China holds about $3 trillion in Chinese government debt. Altogether, central banks worldwide hold approximately $25 trillion in government bonds. That is only about 8% of the total 317 trillion in global debt. But do not underestimate it. This is the foundation of the entire system. Central banks create money specifically to buy government bonds. That allows governments to spend far beyond what they collect in taxes. Now here is the part most people never question. Who owns the central banks? The Federal Reserve, for example, is not owned by the government. It is a private institution owned by its member banks. The 12 regional Federal Reserve banks issue shares to commercial banks. Those banks receive a fixed annual dividend on those shares. So when the Federal Reserve holds trillions in government bonds and earns interest on them, that interest ultimately flows back to the private banking system. Most people believe the Federal Reserve is a government agency. It is not. It is a privately structured banking system created in the early 20th century to allow private banks to profit from government debt. This is not new. The Bank of England was created centuries ago as a private institution for one simple reason: to lend money to the government. The government needed funds for war, so Parliament approved the creation of a private bank. That bank lent money to the state and, in return, received the exclusive right to issue currency. From the very beginning, central banks existed to benefit private financiers by turning government debt into a profit machine. Today, the ownership structures are more complex and hidden, but the mechanism is exactly the same. Central banks create money. They lend it to governments through bond purchases, and taxpayers pay the interest. Now let's move to the second category of creditors: institutional investors. This group includes pension funds, insurance companies, mutual funds, and sovereign wealth funds. Together, they hold roughly $120 trillion in global debt. Pension funds alone hold about $50 trillion. Insurance companies hold around $35 trillion. Mutual funds hold roughly $25 trillion. Sovereign wealth funds hold about $10 trillion. But who actually controls these institutions? Pension funds are technically owned by workers, but workers do not control them. Professional fund managers do. And those managers are paid based on how much money they manage, not on how well they serve workers. Insurance companies are owned by shareholders, and stock ownership is heavily concentrated. The wealthiest 10% of households own nearly 90% of stocks and bonds. So insurance companies are effectively owned by the wealthy. Mutual fund giants manage tens of trillions in assets. Some are structured as investor-owned in theory. Others are publicly traded. But in every case, real control sits with management, and the financial upside flows overwhelmingly to wealthy shareholders. The pattern is always the same. A small management class controls massive pools of capital, and the benefits concentrate at the top. Now the third category: foreign governments. Foreign governments hold roughly $30 trillion in debt issued by other countries. Some countries hold trillions in foreign assets, including large amounts of United States Treasury bonds. Why would one country hold another country's debt? Because of the global trade system. When a country exports far more than it imports, it accumulates foreign currency. Those dollars do not just sit there. They are recycled back into government bonds. So trade surpluses turn into debt holdings, and debt holdings turn into long-term influence over the global financial system. And that leads us to an even deeper layer of the story. In the short term, this system looks like a win for everyone involved. The United States gets cheap goods. Other countries finance those purchases by lending the money right back. But over time, it creates dependency. And inside those countries, who actually benefits from holding trillions in foreign bonds? Not the average worker, not ordinary families. Those bonds are controlled by political and financial elites. Now we reach the fourth category of creditors: wealthy individuals and family offices. The top 1% globally controls roughly $40 trillion in financial assets, much of it parked in bonds. The top 0.1% controls around $20 trillion. And the top 0.01%, just a few 100,000 families worldwide, control roughly $10 trillion. This is how extreme wealth behaves. When you have billions, you do not chase risk. You buy assets that pay steady interest. Government bonds, corporate bonds, safe, predictable cash flow. If a family holds $10 billion in bonds earning 4%, that is $400 million a year in interest. Every year. No labor, no production, just collection. That money comes directly from borrowers, from taxes, from corporate profits squeezed out of workers, from mortgage payments made by households. This is the core engine of wealth concentration. The wealthy lend to everyone else, and they collect interest forever. Now let's add everything together. Central banks hold about 25 trillion. Institutional investors hold around 120 trillion. Foreign governments hold roughly 30 trillion. Wealthy individuals hold about 40 trillion. That is over $200 trillion of the 317 trillion total. The remaining debt is held by smaller institutions, corporate treasuries, and middle-class savers through retirement funds. But even that is heavily skewed upward because wealth itself is concentrated. The bottom half of humanity owns almost no financial assets. They hold debt, mortgages, student loans, credit cards, car loans. They are the borrowers. The top 10% owns most financial assets. They are the lenders. So who is the creditor? The wealthy. Operating through central banks they influence, institutions they control, and assets they hold directly. The debt system is a machine designed to move wealth from those who borrow to those who lend. And this is not new. Let me show you how this has worked throughout history. In medieval Europe, lending power was concentrated in religious institutions. Kings borrowed to fund wars. When debts could not be repaid, land changed hands. By the end of that era, enormous portions of land were owned by lenders, acquired through debt enforcement. In Renaissance Europe, powerful banking families rose to dominance through lending. They financed kings, religious authorities, and merchants. Interest income became more powerful than trade or production. Eventually, lenders gained political influence that rivaled governments themselves. Then came the formal blueprint. A private institution was granted the exclusive right to create money. That institution lent to the government. Taxpayers paid interest. Shareholders collected income forever. That model spread everywhere. By the 19th century, private banking dynasties perfected it. They lent to every major government. They held enormous portions of sovereign debt. Interest flowed in from entire nations. Their wealth surpassed that of countries. In the early 20th century, the same model expanded into industrial economies. Banks financed governments, infrastructure, and corporations. A small number of financial institutions controlled massive shares of national wealth. Across 800 years, the pattern never changed. Those who lend grow rich. Those who borrow grow dependent. Lenders collect interest without producing anything. Borrowers work, create value, and still owe more every year. And the system is structured so the debt can never be fully repaid. Here is why. When money is created through debt, only the principal exists. The interest does not. If the total money supply is 100 trillion, but total debt including interest is 120 trillion, full repayment is mathematically impossible. So what happens? New debt is created to pay interest on old debt. That makes total debt larger, which requires even more borrowing. Debt grows exponentially. That is why global debt exploded from around 40 trillion in the early 1990s to more than 300 trillion today. It roughly doubles every 10 years. And it has to. If new debt stops being created, there is no money to pay interest on existing debt, and the system collapses. The architects of this system understood that from the beginning. Perpetual debt means perpetual interest, and perpetual interest means perpetual wealth transfer. Now let's look at what this means today. In a single recent year, global interest payments totaled roughly $15 trillion. That is 15 trillion flowing from borrowers to lenders in 12 months. Governments pay interest through taxes. The United States alone pays close to $1 trillion per year just in interest. That money comes from taxpayers and goes to bondholders. Corporations pay interest through profits. Globally, companies carry around $90 trillion in debt. They pay about $5 trillion in interest every year. That money comes from lower wages and higher prices. Households pay interest from income. Families worldwide carry roughly $60 trillion in debt. They pay around $3 trillion in interest annually. For many households, interest alone consumes a massive share of income. So that $15 trillion moves upward. From workers, from families, from taxpayers, to central banks, institutional investors, foreign governments, and wealthy individuals. The top 1% captures roughly 40% of that interest income. That is about $6 trillion a year going to a tiny fraction of the population. The concentration increases as interest compounds. Interest buys more bonds, which generate more interest, which buys more bonds. For creditors, wealth grows exponentially. For borrowers, debt never ends. This is the real wealth concentration mechanism. Debt funnels value from billions of people upward, from millions to thousands, from thousands to a handful of families at the very top. And once you see it, you cannot unsee it. They did not stay rich by building businesses forever. They built the first layer of wealth through business, sure. But lasting wealth came from lending. They parked their money in bonds. They collected interest. They reinvested. And generation after generation, the system did the work for them. As long as the debt system keeps running, their wealth keeps growing. And the system has to keep running. If it stops, everything breaks. Governments cannot function without debt. Corporations cannot grow without debt. Households cannot buy homes, cars, or education without debt. The modern economy is built entirely on borrowing, and borrowing requires creditors. Those creditors are the wealthy. They use the debt system to extract wealth from everyone else through interest payments that never stop, because the debt itself can never be fully repaid. But here's the part most people miss. The system has a mathematical limit. Debt cannot grow forever. Global debt is already around 330% of global output. Debt grows at roughly 7% per year. The economy grows closer to 3%. If that continues, global debt will push past 400% of output within the next decade. At that level, interest payments alone would consume nearly half of all economic production. That cannot last. Something breaks. There are only three possible outcomes. 1. Governments default. That wipes out bondholders but collapses the financial system. 2. Governments inflate. That reduces the real value of debt but destroys savings and purchasing power. 3. Governments reset the system through debt cancellation, which rewrites the social order. Every one of these outcomes hits the middle class the hardest. Why? Because the wealthy are protected. They hold hard assets. They hold multiple currencies. They hold globally diversified investments. The middle class holds debt, local currency, undiversified assets tied to one economy. That is not an accident. The system is designed to concentrate wealth during both booms and crashes. During expansion, the wealthy collect interest. During collapse, they buy assets cheap. We have seen this before. During the Great Depression, farms were seized through foreclosure. Wealthy investors bought them. Independent farmers became tenants. In the financial crisis, homeowners defaulted. Large investment firms bought hundreds of thousands of homes at massive discounts. Home ownership fell. Corporate ownership surged. The next crisis will follow the same script. When the debt system cracks, households loaded with debt will default. Those holding liquid capital and assets will buy everything at a discount. This is not a failure of the system. It is the function. The $317 trillion debt system is not a mistake. It is a wealth extraction engine. It pulls value from the many and delivers it to the few. In good times and bad, you cannot opt out. You pay interest on your mortgage to a bank owned by shareholders who are overwhelmingly wealthy. You pay taxes that service government debt owned by wealthy bondholders. Every price you pay includes an interest component that flows upward. The average household pays tens of thousands per year in direct and indirect interest. Over a lifetime, that becomes well over $1 million transferred upward. This is the system. Create money through debt. Charge interest. Collect forever. Make sure the debt can never be fully repaid. So if everyone is in debt, who is the creditor? A small global elite, operating through central banks they influence, institutions they control, and assets they hold directly. They are creditors to everyone else. And the interest payments flowing from billions of people to a few million is the largest wealth transfer in human history, happening quietly, every day, inside every transaction. Even the collapse will favor them, because when paper claims fail, they convert them into real assets. The system extracts wealth during expansion, and it extracts wealth during collapse. Now you know who designed it, and why they always end up as creditors, while everyone else remains a debtor. $317 trillion in debt, $15 trillion a year in interest. That is how the modern global economy moves wealth from the bottom to the top. And if this showed you who really holds the debt and how the system works, stay with me. Because the next question is bigger. What happens when $317 trillion becomes $500 trillion? When interest payments exceed global output? Default, inflation, or reset? Which path the elite are preparing for? and why will decide whether wealth is preserved or erased when the system finally breaks.